Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
Hello, ladies and germaphobes, or germites, or germaphobes, or gentlemen. Let's call you all gentlemen. A scholar and a gentleman would never put all their money into stocks, bonds, and mutual funds and let anyone rip them off. Whatever. I never know how I'm going to start the show, but here we go. This is episode 99. Now, technically, this is the 100th episode I've recorded because I have a 000 episode, but I'm going to save all the fireworks and special occasions, fireworks and special stuff for the true episode 100. I don't even know what I'm going to do yet. Decisions. I'm not even sure what I'm going to do. But this episode, 99, is what if the stock market did not exist? What if it didn't exist? And, better yet, we should really say, what if it existed, but it wasn't a choice? You had to be in an elite club to use it or whatever. What if you could not use it as a growth tool? What would you do? Why am I even doing a show like this? Because I can tell you, beyond a shadow of a doubt, that Americans are addicted to the stock market, the most overused retirement tool on the planet or investing tool on the planet is the mutual fund. So anything market-related, securities in general, okay? Don't put all your eggs in one basket. And what they do is they give you a bunch of different eggs, different securities, or different investments and stick it into one basket called securities, or only what we sell so that we can earn a fee and go play golf. Don't pay attention to the things without risk or without fees. Don't do that because we can't play golf anymore. Don't know why my accent changes in the middle, but maybe it is schizophrenic. I don't know. But if the stock market didn't exist and you had to use other tools, you can still earn the same amount of money or possibly more. I think it's beating the stock market, the alternative, the marketless portfolio. But forget whether it is or not. It's a good exercise to know what you would do if you didn't do what you're currently doing or what you're saying no to and why. Because listen, I know it's cliche, but you do not know what you do not know, period. No matter how cliche it gets, that will never become untrue. You don't know what you don't know. Everything I teach, I basically can remember when I learned it. When I learned how to use term riders to lower my commission and give you the best life insurance in the country. No one's ever been able to beat me. When I learned the tax torpedo, that you're taxed on Social Security based on whether you take money out of IRAs or 401ks. When I learned what they're doing, how they're buying options for you inside of life insurance contracts, and how genius it is to have this thing called indexing. What else is out? Oh, when I learned average rate of return versus actual, it blew my stinking mind. Unbelievable. Social Security planning. There used to be over 500 different ways. You and your spouse could take Social Security, and there's software that runs all of them and tells you the best one. Now it's down to 200 and something. But I didn't know any of that before I knew any of that. And what you need to understand about yourself and be humble. Sit down. Be humble. Isn't that a song? I don't know. I'm not ghetto. What you need to know about yourself and what you need to be humble about is you don't know what you don't know yet. And this show really exists to create clarity, to be a windshield, to give you clarity of sight, to help you see so clearly that all your decisions are easy. So I want to help you to see that the stock market is an unnecessary tool, and for people in the retirement world, you really don't need it. It's like meat to a vegetarian. Like, why? They don't need it. They're looking for vegetables and grains and things like that. They don't need the meat. They can get their protein from, beans and rice together or whatever. You don't need it. It's an unnecessary tool. You should only use the stock market if you want to, and if you like it. You certainly should not ever be listening to someone tell you that you have to use the stock market, or that if you want growth or gains or to earn 6, 7, 8, 9%, the only tool that does that is the one that they sell. That's grounds for dismissal instantaneously. That's called being a liar, as called malpractice. All right, so there is on my Instagram page, I keep mentioning my Instagram page because it's just a great place to post pictures because podcasts are an audio format. So if you go to Google and type Instagram and then my name, Charlie Jewett, or if you know how to find Instagram, you just look for my charlie.jewett, webpage or whatever, profile, whatever it's called. You're going to see a picture that I'm looking at right now that says, what if the stock market did not exist? What a coincidence. That's amazing, Charlie. No, it's not. I created it for the show. And you're going to see on the left-hand side, there's kind of an orange boxes, different shades of oranges. Ew, pretty. I like it. And basically what I'm saying is all portfolio management, as geeky and technical and crazy as these guys in suits want to get, I carry this license. I can talk about this without the suit and without being geeky. As crazy as they want to get and as complicated as they want to make it, there's 40,000 different stocks and 8,600 different mutual funds. You need me to charge you fees and play golf and to build a portfolio, bloody, barf. Well, all of those, every one of those portfolios is basically built up of some things that make a little bit of money, some things that make a little bit more, some things that make a little bit more. Typically, we used to put money into cash and money markets and things like that and try to make about 2 to 4%. That's the safe money that's waiting for things to go on sale. So we'd have a bunch of money and just making 2 to 3% maybe until the stock market crashed, and then we take money from there and buy the more aggressive stuff when it was on discount. Okay, so you have some money in cash or money market making 2 to 4%, used to at least. Your bonds, kind of your foundation, right? Money that needs to be safe. The older you are, the more you need in bonds, the less you need in securities or equities. The more you need in bonds, the less you need in stocks. That's basically what they used to tell us. If you're 65 years old, you should have 65% of it in bonds and 35% of it in stocks. Yeah, only if you want to use one tool on the planet, Joker.
All you need are stocks. Da, 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 da. All you need are stocks. Da, 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 da. All you need are stocks. Stocks. Stocks are all you need.
So some of it's making 2 to 4% cash and money market, equivalent tools like that. Some of it's making 4 to 6 in bonds, sort of your safe money it used to be. And you have the rest in stocks trying to make 6 to 8. Well, if you just look at the picture, it says 2 to 4%, 4 to 6%, 6 to 8%. All portfolio management or asset allocation, risk tolerance, all this baloney to keep you in securities was basically built around how much should you have in each of these as somebody charges you to gamble on what the market's going to do and try to protect you from having bigger losses than you want. They're trying to match your risk tolerance with them using only one tool, risk with a side of fees. But it's basically made up of 3 parts: conservative, moderate, and more aggressive. Well, what if that didn't exist? What if you didn't have the option of putting money at risk? Because really, there's only 2 ways to make money when you really, come down to the very basics of investing. You either risk your principal, buy gold, buy stocks, buy mutual funds, buy real estate, buy stuff, try to sell it. Business in general is risking your principal. You buy stuff at wholesale and you hope you can sell it. I just bought a bunch of junk at a Halloween store on November 1st because they dropped it to 50%. I'm sure there's a ton of it they're not going to sell, and maybe they sell it next year, or maybe they lose money on it. Who knows? Restaurants lose money all the time. Food goes bad. If you think about a restaurant, I never wanted to own a restaurant because you either have to tell people, no, I don't have what you want, I didn't order enough, or you have to watch food go rotten because you ordered too much and you always have what people want, but then you have too much. You can't get it perfect. In my brain, that would not work well. Perfectionist alert. Yup. So what if you could not do this? What if you couldn't risk money, which is the one way of earning, investing? The other way is to commit to a time frame. CDs, annuities, life insurance. You say to somebody, some entity, loans work this way, like private loans, first trust deeds. You say to somebody, you can have my money for 5 years. You can have my money for 10 years. If I need it, I'll pay a penalty, but you can use it. And for that, I want something in exchange. So if you couldn't use the risk your money and hope for the best gambling model, how would you build a portfolio? And this is becoming very, very important in my practice. Because if you can't think this way, I don't think you can think. What did I just say? That's too many thinks. You need to think, what if it didn't exist? What does it look like to go 100% out of the market? How would I build a retirement plan? And then come back to the market and say, does this do anything for me that I don't already have? That's the way you see the strength of this tool called stocks, bonds, and mutual funds, or what it could possibly do for you. And frankly, in my opinion, it does absolutely nothing for a retiree. It doesn't take care of long life, short life, rough life, sick life, or the next life very well. Maybe rough life. Yes, your portfolio is liquid if it hasn't just lost 30%, because you're not going to want to take it out then. And if it's not making 30%, because you're not going to want to take it out then. So as long as it's stagnant, it's pretty liquid. Well, let's take a look at this. This is called the non-market portfolio, or the stockless life, or the stockless portfolio. And by the way, I didn't even mention this. Duh. I really can't move on without mentioning this. Is cash making 2 to 4% right now? Does anybody have money in their money market account that's paying 3% while you sit around and wait for the market to crash? No. You'd be lucky to get 0.3%. How about bonds? Are they super safe, not going to default, and paying, 5% like clockwork right now? There's hundreds to choose from where they all want to pay you 5% to use your money for a little while. No. How about stocks? How about the market? Is it giving us a 6 to 8% right now? Yeah, if you only measure it from 2008. So if you only look at recovery after a giant loss in 2008 and 2009, and you go, yeah, things have been doing pretty well. My guy's doing a good job. Well, all the boats go up when the tide goes up, so we don't know if your guy's doing a good job. Everybody's been making money while the government's buying their own bonds. Quantitative easing alert. Right? Or the Trump run-up, whatever's going on. Does anybody really think companies are worth what their stock prices are at right now? When the head of the biggest bank in the world, Goldman Sachs, has just said the market's been going up for too long? We're over 108 months, I think, on this bull market, and the average is 49 before you have a 27% loss. The market's more expensive than it's ever been. Let me just put that in perspective. If Costco came out today with full-page ads and television commercials and they said, we have never sold couches at such a high price. Prices are higher than they have ever been on couches. Would you run down to Costco and buy couches? No. What are you still doing in the stock market if prices are as high as they've ever been? What are you still doing putting money into IRAs and 401ks that are going to turn around and buy that market at prices that are higher than they have ever been? Why aren't you selling? Don't take my recommendation from the podcast. Call me and let's talk about it. Get in touch with me, charlie@jewettwealth.com, CHARLIE @JEWETT wealth.com. Give me a call, email me, whatever. We can talk about it, but to not sell is to buy. If you don't sell your real estate at the top and you let it drop by 30% and then you sell it, you lose the 30%. To not sell is to buy. If you don't sell your stocks at the top and move to something more conservative, you will take the loss. You're buying at the most expensive the price has ever been, and there's someone charging you money to tell you to do it. Scam alert! Get rid of that joker broker. Okay, so no, these things are not paying 2 to 4% on cash. Bonds are not paying 4 to 6. Stocks have been paying 6 to 8 in the short term, but certainly not since 2001 until now, or 2000 until now.
Here's a song that I always hear the jokers singing when they don't know I'm listening. Oh yeah, I manage your money. I'm gonna rip you off when I manage your money. I'm gonna rip you off. I'm gonna rip you off. I'm gonna rip you off.
But let's look at the stockless portfolio. What else could we do to build something similar? How do we build a portfolio of sorts without the risk, without all those fees, and actually earn the amounts we need? Well, you'll see on the picture on the green side, always look on the right side of life. On the right side, right? You can see 3 tools: modified endowment contracts. That's a life insurance contract that you fund all up front instead of over time. Growth annuities. These are super simple, like a CD, basically. You buy it for 6 to 8 years. I guess there's some that go up to 16, but you buy it for a time, and they give you absolutely phenomenal terms. And then the third one would be tax-free insurance contracts. That's the other way of buying life insurance that E.F. Hutton taught us. You do a 5-pay or a 6-pay. You put the money in as fast as you're allowed to, as far as IRS rules, which is about 5 or 6 years. Some people can do 4 based on your age. But you don't put it all up front. You fund it in a way where your growth is completely tax-free. This is the rich man's Roth IRA, taxed just like a Roth IRA. If you saw the historical returns, which are accurate, by the way, there's no lies built into it like the brokers do. If you saw the accurate historical returns, you'd go, oh my. You guys want to know what the most common things ever said to me are, besides, I hate your show, you jerk, from the Joker Brokers? The most common things ever said to me from consumers are, why isn't everybody doing this? And that sounds too good to be true. Why isn't everybody doing this, Charlie? Wait a minute, that sounds too good to be true. It's not too good to be true. Gravity always pulls you towards the earth. You never fly away and burn up in the sun. Wait a minute, that sounds too good to be true. All my alarms are going off. I'm not going to trust you, you buffoon. Really? Forks never fly out of the drawer and stab you in your eye for no reason. No, that sounds too good to be true. It has to happen on Tuesdays. No, it never happens. Forks don't fly on their own, dude. People, something sounding too good to be true doesn't mean it doesn't exist. If you don't think something exists, you go and you look to see if it exists. I'll give you the phone numbers for the companies that offer everything I talk about. That's my job. I'm an agent. I represent all of the companies in the country and look through every product, throw away the crappy ones, which is about 96%, and then keep the Taylor Swift musician versions of them. Musicians don't make good money, but some do. You can't say musicians don't make good money because Taylor Swift does. You can't say annuities suck because some don't. You can't say life insurance is too expensive because some of them aren't, especially if the agent knows what they're doing. So look on the right side. In the green, if you want to build a portfolio of sorts or a range of different rates of return, if you want to have some cash that's sitting around waiting for things to go on sale, if you want to have some foundational money making 4 to 6% that's never going to go down, no one's charging you any fees, and then if you want some super awesome growth money plus never pay taxes on it, why don't we just use a combination? Why don't we just asset allocate with assets that don't go down as opposed to using risk with a side of fees and use an assortment of life insurance and annuity contracts? You see, here's what's interesting. People all the time go, oh, Charlie's just an annuity guy. He's just a life insurance guy. I did a seminar recently, and on one of the worksheets, this was in Chicago, one of the worksheets somebody wrote, I didn't know it was going to be all about annuities. And I didn't mean to teach all about annuities, but when I teach my seminar, I teach in-case accounts, income accounts, and increase accounts, emergency funds, income tools, and growth, which is what everybody needs. So for emergency funds, single premium life insurance is beating the pants off everything. Well, basically, it's taxed like an annuity. A MEC, modified endowment contract, for all intents and purposes, is taxed exactly the same as an annuity, even though it's a life insurance contract. For income, annuities are beating everything. For growth, annuities are beating the stock market. Growth annuities are beating the stock market. So if annuities are beating the stock market for income, and they're beating the stock market for growth, now think about retirement. Income and growth. You need your money to pay you. That's the definition of retirement. And you need it to grow, so you can pay for medical expenses or leave an inheritance or cover inflation. If annuities are beating the stock market in every single thing that a retiree needs, how would I teach a seminar and not talk about annuities? Goofball? These comments are silly. You walk into a vegetarian store and go, where's the meat? Where's the beef? Anybody remember that from the 80s? Where's the beef? Or I've fallen and I can't get up. Why are we talking about commercials? I don't know. But you go to a vegetarian store and say, hey, where's all the meat, you jerk? How come you don't offer meat? The guy goes, my target market is vegetarians. My target market is people that don't eat meat. Don't curse me because I don't have meat. Well, think about my target market. People that need to have an income for the rest of their life because they're unemployed now until they're dead. That's called retirement. And people who have no idea what taxes are going to be, what inflation is going to be, what medical costs are going to be, how long you're going to live, what emergencies your kids are going to have, what any cost, everything's a variable. So we got to grow your money and give you an income. But I don't want you talking about annuities. Let's just go talk about inferior products so that I have more variety while I eat my free steak you paid for. No, thank you. Anyway, back from that rant. On the green side, on the right side of life, what if the stock market didn't exist? You can build a portfolio that beats the pants off of the stock market in almost any time frame. Someone would have to go find the best years possible in the stock market to say, look, it was worth all the risk and all the fees because you would have beat this. Yeah, you would have beat it if that's the only time you were alive and you died at the right time. Is it really going to repeat itself with all the baby boomers retiring now? Mr. Joker Stupid Face, wasn't that during a time where the largest group of people that's ever worked was working and buying the stock market every week or two when there was money getting sucked out of their paycheck and they're putting money into IRAs? So what drove the market up was that giant group of people buying stocks, bonds, and mutual funds because their job required them of it And then now they're retiring at $10,000 a day, selling them off and putting them into annuities, not putting any more money in, and taking an income out, which all of those things are selling positions. So while they were buying, the market went up. Now while they're selling, you geniuses are saying, nah, the market will keep going up. It always goes up. Really? 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 Then you, my listeners, not only are buying, so if you're still working, still having money taken out of your paychecks, still putting money into IRAs, Roth IRAs, SEPs, not only are you still buying on a consistent basis, the market, when the prices have never been this high, come on down, we've never charged this much, hear ye, you can get ripped off worse than ever. And you're going, I'll take it every 2 weeks of my paycheck. Or every tax season, because my CPA says I need a deduction, so let's put more money into IRAs that are then going into the stock market, if you really look. But you're also leaving your entire retirement savings, important word, all the money you've saved for retirement, you're leaving in investments where you're going to take the next 27, 30, 40, 50% loss when the market inevitably corrects as it always does. You cannot say the market always goes up. You can say the market always adjusts and has a time that it goes down before it begins to go up again. It goes down quick, up slow. You want to lose 30% in a year or two and then take 5, 6, 7 years to get it back at this age you're at, your family will never be the same again. You go down for 2 years and up for 5, you just lost 7 years of compound interest that you can never get back. The most important thing in growing money is time, compound interest over time. And if you use investments and you lose 5, 6, 7 years at a time because you have to recover back to what you already had, your family will suffer forever. You can never have as much money as you could have. Every generation has less because of your choices. Does that happen inside of life insurance and annuities? 100% no. Unless you put your money in variable annuities, which would be silly. That's just mutual funds with 4 times the expenses. If you use a portfolio of the right products, you have almost no fees. You could have no fees. I could show you no-fee portfolios where there's literally not a single dollar coming out. When the market goes up, you know how many tools exist right now that are giving you 45 to 50% of the S&P 500 when it goes up? At the recording of this podcast, the amount of life insurance and annuity products that'll give you 45 to 50% of whatever the S&P 500 does, so basically half the growth, with no losses, sometimes no fees, nothing negative. So when it goes down, you don't lose. When it goes up, you get half of it. Imagine that. Somebody says to me, you don't have to put any money into real estate, and on the appreciation, you get half of it. But if it loses money, I'll eat it. It's like, or, I don't know if that's a good analogy, but whatever. You no risk, no down. And are there risks with everything? Yeah, there's risk with everything. You can look at the disclosures for every company that says, no, we've never had a company go out of business, but we might be the first. So fine. There's a risk that's never happened. I don't carry flying cow insurance to protect my roof because I've never had a flying cow go through my roof. But Charlie, it could happen. A cow could jump on a trampoline high enough to hit your roof, and then you couldn't pay for it. So I'm going to give you the wheelie-dealy flying cow insurance. No. I'm not trying to protect you against things that have never happened. I'm trying to protect you against the things that happen all the time. Long life, running out of money before you die. Short life, somebody predeceasing the other person, losing his Social Security, losing the tax deduction when you're married. Right? Maybe losing pensions and not having enough income. Rough life, having to pay penalties when you access your emergency fund or not having enough emergency funds. Sick life, holy smokes! Trying to protect you from the $8,000 to $9,000 a month for over 2 years that you have a 71% chance of one of you in the marriage going into long-term care. It'll destroy your estate for the person who remains, and then you got nothing left for the kids. Trying to protect you against things that actually happen. Go to Instagram. Instagram, my profile or whatever you call it is charlie.jewett, charlie.jewett. Look at this picture and just for yourself, just think, if I didn't have the stock market, what could I do? You can easily make 2 to 4 with life insurance and annuities. Simple, completely liquid products. No penalties to get the money back whenever you want to, just like cash, just like money markets are supposed to do. You can easily get 4 to 6 with growth annuities. No fees whatsoever. Never lose money when the market goes down. Just get some of it when it goes up. Let's say half the S&P 500. And you can easily, if it's built the right way, as opposed to by somebody that does, supposed to be being built by somebody that doesn't know what they're doing, you can easily get 6 to 8 tax-free inside of a properly built life insurance contract if you really want some whiz-bang stock-like money in your life. And oh, by the way, it comes with long-term care, and it comes with a death benefit, it comes with the ability to borrow against it, it comes with the ability to borrow against it and create arbitrage, it comes with liquidity, it comes with blah, 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 a billion other things that the stock market doesn't offer. Other than that, I don't have any strong opinions on the subject. People, get in touch if you want help. Email me, Charlie, at jewett.wealth.com, Jewett, wealth.com. Hopefully you can spell wealth. Charlie, Charlie, at jewett.wealth.com, Jewett, wealth.com. And my team will help you. We're looking forward to helping you. Why? Because we think you people are the best.
Renovating retirement with Charlie Jewett.
But that's all, folks.